Once every several years, the gold-silver ratio does something that makes every serious precious metals analyst stop what they are doing and pay very close attention. It flashes a signal so rare, so historically significant, that ignoring it has cost investors fortunes and recognizing it has made them. That signal just flashed, right now, and if the pattern holds the way it has held every single time this has happened in modern market history, silver's next move is going to shock a lot of people who weren't paying attention. I'm going to walk you through exactly what this signal is, why it matters more right now than it ever has before, and what history says comes. Next, stay with me, because this is one you genuinely cannot afford to miss. Let's establish what we're actually looking at before anything else, because precision matters here. The gold-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has spent the last several years in extreme elevated territory. It spiked above 80, pushed toward 90, touched levels that in historical context represent profound, almost extreme undervaluation of silver relative to gold. And now, something has changed. The ratio has begun compressing, moving lower in a way that technically, structurally, and historically qualifies as one of those rare inflection signals that traders and analysts track with obsessive attention. The compression isn't just a random wiggle on a chart. It has specific characteristics: the speed of the move, the level from which it originated, the macro backdrop against which it is occurring, that together constitute what experienced ratio watchers describe as a genuine reset signal. And those reset signals, when they appear, have preceded some of the most violent and profitable silver rallies in modern market history. Now let me give you the historical weight behind that statement, because this is not opinion or speculation. This is documented market behavior going back decades. Every major silver bull run in the modern era has been preceded by a gold-silver ratio peak and subsequent compression. In the early 1980s, when silver ran to nearly $50 an ounce in its famous historic spike, the ratio had been deeply elevated before the move. In the 2000s bull market, silver went from under $5 to nearly $50 between 2003 and 2011, a gain of close to 900%, and the entire journey was accompanied by a steady, relentless compression of the gold-silver ratio from above 80 down toward 30. In 2020, the ratio hit an extraordinary peak above 120 during the pandemic panic, and what followed was silver nearly tripling in price in just a few months as the ratio snapped back. The pattern is not subtle, it is not ambiguous. Every single time the ratio has peaked at extreme levels and begun a genuine compression cycle, silver has dramatically outperformed not just gold, but virtually every other asset class on the planet. So the first question every intelligent investor should be asking right now is, what makes this particular signal rare? Because ratio compression happens periodically, what makes the current signal different from ordinary fluctuation? The answer lies in 3 specific characteristics that have to align simultaneously for the signal to qualify as genuinely rare. First, the ratio has to originate from an extreme elevated level, not just above average, but in the upper range of its entire modern historical distribution. Check. Second, the compression has to be occurring against a specific macro backdrop, one where the forces that drove gold higher in the first place are still intact, meaning gold is not falling while the ratio compresses, but rather silver is rising faster than gold. That distinction is critical. A ratio compression driven by gold collapsing is not a bullish signal for silver. A ratio compression driven by silver surging while gold holds or also rises, that is the signal, and that is what we are seeing now. Third, the compression has to be occurring at a point where silver's fundamental demand picture independently supports a major move higher, meaning the ratio signal is not standing alone but is being confirmed by real-world supply and demand dynamics. And with everything happening in solar, EVs, AI infrastructure, and semiconductor manufacturing, that third condition is more powerfully met right now than at perhaps any previous ratio signal in history. All 3 conditions are aligned. That is what makes this rare, and rare signals in financial markets deserve serious attention from serious investors. Let me go even deeper on the mechanics of why the ratio works the way it does, because understanding the why gives you the conviction to act on the signal rather than second-guess it. When volatility tries to shake you out, gold and silver are linked by monetary history going back thousands of years. They are both stores of value. They both respond to inflation, currency debasement, and geopolitical uncertainty. But they respond at different speeds and through different channels. Gold responds first. It is the institutional metal, the central bank metal, the sovereign wealth fund metal. When macro fear rises, gold moves quickly because institutional money can move into gold in enormous size without dramatically disrupting the market. Silver is different. Silver's market is smaller, thinner, and slower to respond to institutional macro signals, so gold runs first, the ratio spikes, and silver lags. But then the catch-up happens, and when it does, the math of a smaller market absorbing surging demand creates price moves that are proportionally far larger than gold's moves. That catch-up phase is what ratio compression signals. When the ratio starts falling from an extreme peak, it is telling you that silver's catch-up has begun. The question is never if the catch-up will happen, it always has. The question is how fast and how far, and the current setup with silver's industrial demand story adding an entirely new layer of fundamental support that didn't exist in previous ratio cycles suggests the answer to both questions could be more dramatic than anything we have seen before. If you are finding this analysis valuable and want to keep getting this level of depth on precious metals and macro markets, please hit that like button and subscribe to this channel right now. This community is growing fast, and we are putting out content every week that you genuinely cannot find anywhere else. Let's talk about the price math that ratio compression implies, because this is where things get very concrete and very interesting. At the current moment, with gold at elevated levels and the ratio having peaked and begun its compression, the price targets that emerge from historical ratio normalization are extraordinary. If the ratio compresses from its recent peak back to 60, which is near the modern long-term average, the implied silver price, depending on where gold sits during that compression, ranges from significant double-digit percentage gains to potentially more than 50% above current levels. If the ratio compresses all the way to 50, which has happened multiple times in history, the implied silver price targets are even more dramatic. And if we get the kind of overshoot to the downside on the ratio that has occurred at previous major cycle peaks where the ratio has compressed all the way to 30 or even below, then the silver price targets that emerge from the math become genuinely historic numbers. The ratio compression is not predicting a modest rally. It is signaling, based on the weight of historical evidence, a potentially generational move. Now I want to address something that every skeptical investor is probably thinking right now, because intellectual honesty demands it. Why doesn't everyone just trade this signal if it's so reliable? If the ratio always predicts a silver rally when it compresses from extreme levels, why isn't it already priced in? The answer is layered and important. First, time horizon. Ratio compression cycles play out over months and years, not days and weeks. Most market participants are focused on what is happening right now, this week, this quarter. They do not have the patience or the conviction to hold a position through volatile months-long consolidations, waiting for a ratio-driven thesis to fully play out. Second, volatility. Silver is one of the most volatile assets in existence. During even the strongest silver bull markets, there are corrections of 20, 30, even 40% along the way. Those corrections shake out weak hands investors who bought the thesis intellectually, but didn't truly understand the time horizon and the volatility profile they were signing up for. Third, narrative. The mainstream financial media does not talk about the gold-silver ratio in any meaningful way. It is not a concept that gets airtime on major financial networks, so most retail investors and even many professional investors are simply unaware of the signal. The gap in understanding is what creates the opportunity. Markets don't give away easy money to the majority, they reward the informed minority who have done the work. Let's talk about what typically happens in the market in the weeks and months immediately following a rare ratio signal like this one, because understanding the playbook helps you navigate what's coming without getting shaken out at the wrong moment. The first phase, which may already be beginning, is what traders call the awakening phase. Silver starts moving higher with more conviction than it has in recent months. The ratio begins compressing visibly. A small number of informed investors and institutional traders begin positioning aggressively. Volume in silver ETFs starts picking up. The futures market positioning, reflected in the commitment of traders report, begins shifting, with speculative long positions building and commercial short positions gradually reducing. This phase is relatively quiet from a media perspective. The mainstream hasn't noticed yet. The second phase is the acceleration phase. This is when silver's momentum becomes impossible to ignore. The price has moved enough that financial media starts covering it. Retail investor interest surges, search volume for silver investing climbs, social media discussions multiply, YouTube videos about silver start getting much higher. View counts, inflows into silver ETFs like SLV accelerate dramatically. The futures market sees a surge in open interest as more participants pile in. This is the phase where silver's moves per session get larger. 2% days become 3% days, 3% days become 5% days. The volatility that silver is famous for starts working to the upside rather than the downside. This is the phase where the majority of the percentage gains are captured by those who positioned in the awakening phase. The third phase is the overshoot phase, and understanding this phase is what separates truly sophisticated silver investors from everyone else. In every major silver bull run driven by ratio compression, silver has not stopped at the point where the ratio returned to its long-term average. It has overshot, the ratio has compressed. Past 60, past 50, past 40, sometimes all the way to 30 or below. This overshoot happens because by the time the acceleration phase is fully underway, emotional momentum has taken over from rational valuation. Investors who miss the move are chasing, media coverage is intense and uniformly bullish, FOMO is driving decisions rather than analysis. Silver goes further than the fundamental math would suggest, and then eventually it corrects. The investors who understand the three-phase structure can ride the overshoot while staying aware that it is an overshoot and can scale out of positions intelligently as the ratio approaches and then breaks through historical support levels on the way down. This three-phase understanding is genuinely one of the most valuable frameworks any precious metals investor can have, because it tells you not just that a move is coming but roughly where you are in the cycle at any given point. Right now, based on everything the ratio signal is telling us, we appear to be transitioning from the very early stages of the awakening phase into the beginning of something larger, that positioning early enough in the cycle that the mainstream hasn't arrived yet, late enough that the signal has clearly activated, is historically the single best entry point for silver exposure. Let's also discuss the macro environment layered on top of the ratio signal, because the two are not independent of each other. Right now, central banks around the world are navigating an extraordinarily complex environment. Inflation has proven stickier than models predicted. Geopolitical tensions across multiple regions are keeping Safe haven demand for precious metals structurally elevated. Currency confidence, particularly confidence in fiat currencies among populations in emerging markets, is eroding in ways that are driving physical silver and gold demand at the retail level across Asia, the Middle East, and parts of Latin America. At the same time, the industrial demand revolution we have discussed in depth in previous videos, solar, EVs, AI semiconductors, energy storage, is adding a layer of fundamental demand support that has no precedent in the history of the silver market. The ratio signal is occurring against perhaps the most comprehensively bullish macro backdrop for silver that has ever existed, simultaneously with a rare technical signal. That combination is genuinely extraordinary. One more dimension deserves serious attention before we wrap up, and that is the role of paper silver versus physical silver in what comes next. A significant portion of silver trading globally occurs in paper form futures contracts, ETFs, over-the-counter derivatives rather than in physical metal. When a ratio compression cycle accelerates and investor demand surges, the physical silver market can tighten dramatically as buyers seek actual metal rather than paper promises. Physical premiums, the amount above the spot price that buyers pay for coins, bars, and other physical silver products, tend to surge during these periods, sometimes to extraordinary levels. That physical tightening feeds back into the paper market and accelerates the price move. Investors who hold physical silver or physically backed ETFs during these periods benefit from both the spot price move and the potential premium expansion. It is a dimension of the silver market that adds yet another layer of potential return during major ratio compression cycles, and one that sets silver apart from most other assets. The signal has flashed. The setup is in place. History is providing a very clear guide to what has happened every time these conditions have aligned before. The only variable that remains open is timing, and while no one can predict the exact timing with precision, the direction and the magnitude suggested by the historical pattern are as clear as they have ever been. Silver's next move could genuinely shock everyone who hasn't been paying attention to the ratio, and now you are paying attention. Leave a comment below right now. Tell us what your silver price target is for this cycle and whether you are already positioned or still watching from the sidelines. The conversation that happens in the comments of this channel is some of the most intelligent precious metals discussion anywhere online, and we read every single one. And if you know someone who invests in gold but has been ignoring silver, someone who needs to understand why the ratio signal changes the entire calculation, share this video with them today. It could be the most important financial conversation you start this week. We will see you in the next one.